Okay, let's unpack this. Imagine a company like 100 years old, a utility. The kind of business you probably never really think about, right? Suddenly, it's right at the heart of the AI revolution. That's PPL Corporation, ticker PPL. And as we're diving in, the stock's sitting around $36.50. So we've dug into the research, pulled together the key info, but we're trying to figure out for you today is this. Is PPL this hidden gem, the essential power lines behind AI? Or is it maybe a bit of a trap, caught up in regulations and big spending plans?
Yeah, it's a really interesting moment for them. What this analysis really does is frame up PPL's huge strategic pivot. They've spent the last few years basically de-risking the company, shedding international stuff, focusing completely on their U.S. regulated businesses.
Yeah.
And they're doing that specifically to catch this wave of, well, exploding energy demand, mostly from data centers, but also just general electrification.
Exactly. And stick with us because later on, we'll get into why, even though the growth story looks strong and our valuation points to maybe $38 to $42 a share, the biggest hurdle for PPL might not be what you expect. It's not about the tech, it's actually more about social and political factors. Okay, let's dive into Chapter 1, Business Analysis. So first things first, what exactly is PPL? How does it make money?
Right, so PPL is what we call a pure-play, regulated U.S. utility holding company. Think of their core business like a toll bridge, but for electricity and natural gas. They spend huge amounts of money building and maintaining the essential infrastructure. The poles, the wires, the substations. It's a massive long-term investment.
And because everyone needs electricity and you can't just build competing power lines everywhere.
Exactly. It's a natural monopoly.
Yeah.
So state regulators allow them to earn a predictable, consistent return on those investments. They approve the rates PPL can charge.
So they're kind of insulated from the wild swings in energy market prices. It's more about the infrastructure itself.
Precisely. Their profit comes from the approved rates on their infrastructure assets, not from gambling on energy prices. And this infrastructure serves about, 3.6 million customers across three main areas.
Okay, where are they operating?
You've got Pennsylvania regulated, that's mostly transmission and distribution, serving about 1.5 million customers. Then there's Kentucky regulated, a bit different because it's fully integrated. They handle generation, transmission, and distribution for electricity and gas to about 1.3 million customers. And finally, Rhode Island regulated, which is transmission and distribution for gas and electricity, around 770,000 customers.
Okay, but here's where it gets really interesting, right? The AI angle. Why these specific places?
That's the key. PPL is seeing this, massive surge in requests from data center developers, particularly in their Pennsylvania and Kentucky territories. These developers need huge amounts of reliable, often cheaper power. And PPL happens to be in the right spot geographically to potentially provide that.
So they're positioned to be a major supplier for the AI boom purely because of where their existing infrastructure is.
Pretty much. And their competitive advantage, their moat, as we sometimes call it, is really strong. Like most utilities, they have captive customers. It's not like you can easily switch your power line provider, right?
Infinite switching costs, basically.
Plus, huge economies of scale. But they aren't just sitting back. They're investing in things like a self-healing grid.
What does that mean, self-healing?
It uses AI and automation, actually, to detect problems and reroute power automatically, aiming to reduce outages and improve reliability. That's crucial when you're talking about powering data centers.
Okay, so that sets the stage for the business. Let's talk about the people running the show and their plan.
All right, let's move into Chapter 2, Management Evaluation. The CEO is Vincent Sorgi. He's been with PPL quite a while, since 2006, took over as CEO in 2020, and he's really the architect of this transformation strategy we mentioned earlier, selling off the riskier UK business back in 2021, spinning off competitive power generation even earlier. The whole idea was to simplify, focus purely on stable U.S. regulated operations.
And now the focus is growth within that stable framework, which brings us to the spending plan. It's big.
It's huge. The core of their investment story right now is this $20 billion infrastructure plan. That's billion with a B, slated for 2025 through 2028. And that money is going directly into modernizing the grid and expanding it, specifically to handle all this expected new demand from data centers and electrification.
$20 billion. Wow. How does that translate into growth for the company, for investors?
Well, the projection tied to that spending is key. They expect it to drive about 9.8% average annual growth in their rate base.
Okay, unpack rate base for us quickly.
Sure. Rate base is essentially the value of the company's assets that regulators allow them to earn a profit on. So if you grow that asset base by almost 10% a year.
You're directly growing the base upon which you can earn your guaranteed profit.
Exactly. It's how they turn spending into future earnings.
Yeah.
Spend a dollar on approved infrastructure, add it to the rate base, earn a regulated return on it.
And management seems pretty confident they can deliver that. They've tied their shareholder return policy directly to it, right?
They have. They had to reset the dividend back in 2022 after selling the UK business, which was understandable. But the go-forward plan is clear. Target 6% to 8% annual dividend growth through at least 2028. That aligns pretty closely with their expected earnings per share growth.
But spending $20 billion isn't free money. How are they funding this?
That's the catch. They'll generate cash from operations, sure, but they also project needing to issue about $2.5 billion in new shares, new equity through 2028.
So some dilution for current shareholders to fund that future growth.
Correct. It's an investment, but it does spread the ownership thinner.
Now, this all sounds like a pretty solid plan on paper. Big investment, clear growth targets, but execution matters. And they've had a major hiccup recently, haven't they?
Oh, absolutely. We have to talk about the billing issues in Pennsylvania in 2023. This was a big deal. We're talking about nearly 800,000 customers affected by incorrect bills, widespread problems. It was a major operational failure.
800,000. That's
Yeah.
not small. What happened?
It led to a full investigation by the state's Public Utility Commission, the PUC, and, well, the audit found significant operational deficiencies. PPL accepted the findings and is working on fixes, but think about the timing.
Yeah, you mess up billing for almost 1 million people, and then you have to go back to those same regulators and ask for potentially large rate increases to pay for your $20 billion plan.
Exactly. It creates a serious reputational challenge and definitely adds risk to getting those future rate hikes approved smoothly.
Okay, strategy, ambition, some operational stumbles. Let's dig into the numbers themselves in Chapter 3, financial analysis. What does the financial health look like? PPL is a decent-sized company, market cap around $26.85 billion.
Yeah, large cap territory. And generally financially stable. You mentioned the dividend history earlier, paying quarterly since 1946. That's impressive consistency. The current yield is around 3.0%.
Yeah.
Debt to equity is about 1.25, which is, fairly typical for a utility that carries a lot of infrastructure debt.
But one number that jumps out, especially if you're not used to utilities, is the free cash flow, or FCF. It's been negative since 2022. Should we be worried?
That's a really important point. Normally, negative FCF is a big red flag. But for a utility like PPL, right now, it's actually expected. Why? Because they're in the middle of this massive $20 billion spending program. The cash they're spending on building stuff simply outweighs the cash coming in from current operations.
So it's negative because of investment, not because the core business is losing money day to day.
Precisely. It's funding growth. But it does mean they rely on borrowing or issuing equity to cover the difference, which we already discussed.
Okay, makes sense. Now, the $1 million question, or maybe the $36.50 question, valuation. What are the metrics telling us? Is it cheap, expensive?
This is where the tension really shows up. If you look backward, the trailing PE ratio is about 27.1 times earnings.
Whoa, 27 times. For a utility, that sounds really rich compared to history, right?
It is. Historically, PPL traded closer to maybe 21 times earnings, and the peer average is around 20.5x right now. So yeah, 27x looks pricey.
Suggests the market's already baked in a lot of optimism, maybe.
It could. Or it could reflect the unique growth story linked to AI demand. But markets look forward. So the forward PE, which uses estimates for next year's earnings, looks much more reasonable. It's in the range of 18.6 and 19.9x.
Ah, okay. So the market expects earnings to grow significantly, bringing that multiple down.
That's the idea. And if we try to calculate an intrinsic value ourselves, using a discounted cash flow model or DCF, and we plug in management's own growth guidance, that 6% to 8% range, our analysis suggests an intrinsic value somewhere between $38 and $42 per share.
Okay, so with the stock currently at $36.50, that suggests maybe some modest upside, about 4% to 15% potential if they hit those numbers.
That's what the model indicates, yes. But it relies heavily on them executing that $20 billion plan and getting the regulatory approvals they need. Big ifs. All right, let's shift gears into Chapter 4, market sentiment. What does Wall Street think overall? Generally, analysts seem pretty positive. The consensus rating leans towards a buy or maybe moderate buy, and the average 12-month price target is around $38.69, which lines up pretty well with the lower end of our intrinsic value range.
But there's a wrinkle here, something a bit contradictory maybe, the short interest.
Yeah, this is fascinating. PPL's short interest, that's the percentage of shares borrowed by investors betting the price will go down, is sitting between 3.56% and 3.96%.
How does that compare to other utilities?
It's noticeably higher. The average for its peers is around 3.15%.
So more people are actively betting against PPL than its competitors? What's the bear thesis specifically targeting here?
It doesn't seem to be about doubting the overall AI demand trend. The bears seem focused specifically on PPL's execution. They're likely betting that PPL will stumble on deploying that $20 billion efficiently, or maybe more likely, that they'll face major pushback from regulators on rate increases.
Especially after that Pennsylvania billing mess we talked about.
Exactly. That fiasco gives the bears ammunition. They're wagering that political pressure will prevent PPL from getting the full rate increases needed to justify the spending and hit those growth targets.
Makes sense. And technically, where's the stock trading? Any signals there?
It's a bit mixed. The stock, $36.50, is just slightly above its 50-day moving average, which can be a mild short-term positive signal. But it's pretty close to its 200-day average, suggesting the longer-term trend is more neutral, kind of waiting for direction.
Okay, let's look inside the company now with Chapter 5. Ownership structure. Who actually owns PPL stock?
Well, like most big utilities, it's dominated by large institutions. Over 82% is held by institutional investors. You see the usual big names. Vanguard is the largest holder with over 12%. BlackRock has around 8%. State Street, too. Mostly passive index funds.
Standard stuff for a blue-chip utility, but what about the insiders? The executives, the directors, are they holding a lot of stock?
And here's the stark contrast. Insider holdings are extremely low, like 0.13% of the company. Tiny.
0.13%, right?
Yeah. And maybe more telling is the trading pattern. Over the last 12 months, there have been 64 open market sales by insiders.
64 sales. And how many buys?
0. No open market buys reported in the past year.
Okay, wait. So the people running the company, the ones pitching this huge $20 billion growth plan, have collectively sold shares 64 times and bought 0. What does that signal to you as an investor looking from the outside? That seems concerning.
It's definitely a yellow flag, maybe even orange. It doesn't automatically mean the plan will fail. Executives might sell for various personal reasons, but it does suggest a potential lack of deep personal conviction in the stock's future upside at current prices. It means if you invest, you're betting purely on their professional ability to execute, not necessarily that they believe it's a screaming buy for their own money. It puts more onus on your due diligence.
All right, let's pull the risks together now in Chapter 6, risk assessment. We can do a quick SWOT. Strength, weaknesses, opportunities, threats.
Sure. Strengths are pretty clear.
Yeah.
That regulated revenue model gives stability, decent balance sheet for utilities, some geographic diversity within the U.S.
Weaknesses?
Highly capital intensive, hence the negative free cash flow right now. Total dependence on regulators, which is always a risk. And of course, those recent operational stumbles, the billing issues, hurt credibility.
Opportunities seem massive, though. The AI and data center demand, broader electrification trends, and the $20 billion plan itself to capture that growth.
Definitely. Those are the big drivers. Now, for threats, macroeconomic stuff matters. Higher interest rates make their debt more expensive. Potential tariffs on materials could increase project costs, though management says they're managing that.
But connecting all the dots, what's the single biggest, maybe less obvious threat here? You teased this earlier.
For me, it boils down to the social and political risk. This is the core of the skepticism, I think.
Explain that more. How does it play out?
Look, PPL is planning to spend billions. A significant chunk of that is arguably driven by demand from, let's face it, very wealthy big tech companies building power-hungry data centers. When PPL goes to regulators to ask for rate hikes to pay for this $20 billion investment,
There's going to be pushback asking why regular residential customers should pay higher bills to support infrastructure for giant tech firms.
exactly. Regulators will be under immense public and political pressure to shield homeowners and small businesses from rate shock that looks like it's subsidizing AI. If that pressure leads regulators to deny or significantly scale back the requested rate increases, PPL won't earn the return they need on that massive investment.
And that could completely derail the whole 6-8% growth story management is promising.
Absolutely. It's the linchpin risk, in my view.
Okay, let's bring it all home. Chapter 7, conclusion. Synthesizing everything we've discussed, what are the bull and bear cases in a nutshell?
The bull case is pretty straightforward. PPL has simplified its business, focusing on high-quality, regulated U.S. earnings. They're perfectly positioned geographically for the AI and electrification boom, and they have a clear, management-backed growth plan aiming for 6–8% annual growth. It looks like a stable growth story in a vital sector.
Okay, and the counter-argument, the bear case.
The bear case highlights the huge execution risk. Can they actually deploy $20 billion effectively and on budget? Regulatory outcomes are uncertain, especially after the billing crisis damaged trust. They need capital markets because FCF is negative, and that lack of insider buying raises questions about conviction.
So weighing those two, where does valuation land again?
Our DCF analysis suggested that intrinsic value range of $38 to $42 per share. With the stock at $36.50, it's trading slightly below that range.
So a modest discount. It seems like the market is acknowledging the potential, the AI tailwind, but it's also clearly pricing in some of that execution and political risk we've been talking about.
I think that's fair. It's not a deep value play, nor is it priced for perfection.
The real takeaway for you listening, perhaps, is that PPL's success isn't just about engineering or finance. It hinges critically on their ability to navigate the complex social and political landscape. They need to successfully sell this massive investment not just as power for big tech, but as essential grid modernization that benefits everyone, justifying why all customers might need to contribute to paying for the AI revolution's power demands. That's the tightrope they have to walk. Well, that's our deep dive on PPL. If you found this analysis valuable and you want to get priority access as we cover all the S&P 500 stocks, definitely like and subscribe to Stock Analytics AI. Members get priority deep dives for just €4.99 a month. We're churning through the whole index over the coming months. Or if you just want a one-off deep dive on a specific stock you're interested in, drop us a super thanks on the video.
And just a usual reminder, this analysis was generated by an AI system intended purely for educational and informational purposes. It is absolutely not financial advice. Please, always do your own research, dig into the company yourself, or talk to a qualified financial advisor before making any investment decisions.